Hi everyone, in today's video I'm going to cover BlackBerry stock because it is quite important because based off volatility we're seeing from the meme stocks, I want to update the short positions and plus give my thesis that at the same time I didn't necessarily share too much before. I've mentioned in a couple of videos, but I have a video to show that pretty much confirms the thesis is relevant and possible, but at the same time has to be driven with volume. That is the problem. And then you could argue volume always drives up the share price. So then are we seeing what we're really seeing? I think so, but again, volume is needed regardless. But yeah, I do own shares in BlackBerry stock, so do keep in mind while you're watching this video. And I'm not a professional, so please do your own due diligence and research before buying and selling. But before I play the video, currently, by the way, we closed at $2.81 US, and after hours is about $3. Some of them are showing 302, 304. And in terms of short positions, as of May 15th, 2024, so this is delayed. They only report 2 times a month, and it's at 7.15% shorted positions. That are self-reported, by the way, and that's about 42.13 million shares. And then in terms of the Canadian side, because it's traded in two exchanges, so for the Toronto Stock Exchange, bb.to 384 at the close, and short positions is about 3.05%. So combined, because again it is both of them combined, it's about 10.2% shorted, and then about 17.99 million shares for the Canadian side. So combine that's about roughly about 60 million shares shorted. Now that is significant. Again, that's 10.2% total. It is decently shorted, I would say. You could argue heavily shorted, but it is not an extremely shorted territory. To be considered an extremely shorted territory, it has to be above 20%. But the significance of this, in my opinion, because it's decently shorted, my thesis in the past was there's, for example, there's like option contracts and all that stuff. So if you're aware of what options trading is and so on and so forth, but there's naked shorts, then there's uncovered calls that are sold. There's a bunch of options that are being played at the same time. So what I'm saying is it's not just shorting the stock. There's other factors that could be happening in terms of going with or against the stock. Now, even if they're selling uncovered calls, right? So uncovered calls, essentially, this is just a quick explanation, is you don't think the stock is going to go to $10, right? From now to the next, I don't know, 3 months. So to sell that call, you get a premium of 30 cents, let's just say. So if you, every contract you sell, you get a 30-cent premium. Now, usually what you're supposed to do, if you, almost all of you guys are going to have clearance for these higher levels. So most of you guys have lower level clearance, which you have to have shares to back up to sell that call. So you have to have shares to cover it. But if you have higher clearance, you could sell those calls as uncovered calls, which means you don't have the underlying share to back it up. So they'll just sell the calls, get the premium without having the shares to cover it. Now, the risky side of it is if the stock ends up jumping to $20, they still have to have the underlying share to cover it regardless. So they'll have to buy that share to cover that position. Otherwise, close it as soon as possible, but that doesn't happen perfectly. And then in terms of shorted positions in general, and most of these uncovered calls and all stuff, they're all done on margin counts. I believe you basically have to have margin counts anyway to do them. That's basically exactly what it is. So because of the margin counts, and what I'm going to show with the video, because it just basically explains the thesis exactly. I just never explained it fully just because I'm afraid that technically it's just a thesis, right? That's the problem about this stuff. But in essence, if you guys used margin accounts, by the way, which I have, you will notice that, especially the first time you use margin counts by accident, you don't know about the calls being margin called fully. Good thing is my accounts, when I got margin called, they weren't like big plays that I was using. But when they do a margin call, they warn you a little bit. But the thing is, though, if you don't go past the warning, I think you only get like a 24-hour warning max if you're lucky, depending on the position size, they will buy that share regardless of what price it is to cover themselves fully. So you have no choice yourself. So with that, what happens is, for example, right now you're looking at 10.2% shorted positions for BlackBerry stock, right? And then these are self-reported numbers, so it could be shorted even more. And again, this is roughly about 60 million shares. Then there's those contracts that are, for example, could be liable where they have to buy those shares anyway regardless. So all this creates a domino effect, and it not compounds, but it stacks up fully together. Now, the reason why I say you need volume to drive this, and when it comes to meme runs, there's a possibility we could spike up like we've seen back in the first meme run, where it it spiked up. I think it was roughly about like $11 the first day or something, $14 the next day. Then the next day was like $20, $25, and then $28, all in a matter of like 7 days. I can't remember exactly. Is because it created that domino effect, because there's people who are shorting it, and at the same time, they're selling uncovered calls. So it's almost like it doesn't matter if they're shorting it or not, and so on and so forth. There's just so many plays besides just shorting it where it's if the share price rises significantly, they still have to buy the shares regardless. So what I'm saying is there are so many plays than just shorting where shares have to be bought to cover and close positions out if things go to the upside dramatically. Now, the only downfall is, I would say, for BlackBerry stock is when I see like Reddit posts and all that stuff, so on and so forth, there is volume ticks to the upside, but the first run up was amazing because there was a lot of supporting. This time, there is a decent amount of supporting, but the problem is it's not enough where you need those higher levels to hit. So that's why when we see a spike up to the upside, they could pull it down pretty easily with just enough volume on their side, if that makes sense. Like because what happens is when it spikes up, they could open up new short positions and short the stock and bring it down. Now, that technically adds more fuel to a fire if you really think about it. But the problem is you need more of a spike up to the upside, and then you'll trickle like a domino effect to the upside, right? That's the thing. So what I basically want to say is, even though these are self-reported numbers, 10.2, it could be higher. Plus, you have other plays overall that could create a bigger domino effect. And the worst part is, in the video that he states, and I never really thought about this, is these people who are shorting and doing these uncovered calls plays and all that stuff and so on and so forth, and different contract options and all that stuff in terms of without being covered, is they're not really aware fully of how many short positions are open, because he kind of explains a fix for the system. And I was like, okay, that could help out a little bit. So these short positions are only reported twice a month. So if you see, for example, roughly about 60 million shares are shorted, you might open up a position yourself and be like, okay, I'll open up another 10 million shorted shares. Not a big deal. The problem about that is you open up 10 million shorted positions and somebody else opens up like 50 million short positions. Your risk is actually higher than you originally thought it was. And one way to combat that, he was stating, was like post it daily or something like that and update these numbers daily. Again, but they're self-reported, so how reliable can it be? It's hard to tell, but it would be better than twice a month. Plus, he said increase the margin cost for it, because again, when you short a stock, there's margin attached to it, margin cost. So that could combat it. But what I'm saying is this could go up to the upside way stronger than others expect. But again, it does require volume. And what I mean by volume is if people buy the stock and don't sell and the share price goes up, there's only one thing that could happen, is if it drives up so high where the shorts have to cover, the uncovered calls have to buy shares, so on and so forth, the system triggers it automatically to buy the shares or whatever price it is to cover if the excess loss is greater than the holder's margin account could handle. That's the thing. But again, it does require volumes. And then when it comes to meme runs, that's the reason why I think those levels could be triggered when it comes to this, right? So that's it. But again, I do own shares in the company, so do keep that in mind while you're watching. And I'm not a professional, so please do your own due diligence and research before buying and selling. Okay. So now I'm going to play the video, but this is more predominantly for GameStop, basically back in the first meme run. But at the same time, this still holds true regardless for GameStop and all stocks in general, because this goes after the short positions, uncovered calls, and other contract plays and so on and so forth. And I'm going to play right now.
There was insider trading, whether the likes of Robinhood hurt their customers. And
by the way, this is Thomas Petterfee, Interactive Brokers founder and chairman, by the way.
Whether the likes of Citadel are abusing their power. What do you think is the key focus and the likely outcome?
So what I would like to point out here, that we have come dangerously close to the collapse of the entire system, and the public seems to be completely unaware of that, including Congress and the regulators. So let me explain to you that on January 26th, Game had closed at $77 a share. The following day, it closed at $148. The following morning, on January 28th, the stock opened at $355 and traded up to $400.
So I don't know if you guys can tell, but that's a matter of like 3-4 days, right? It jumped significantly. Now, again, that is due to the domino effect. Now, GameStop was shorted over 100%, but at the same time, it's not just, he's going to explain soon, but it's not just the shorted positions, it's the contracts too, the options chain.
So, at the same time, Game had 50 million registered shares outstanding and a short interest of 70 million shares. In addition, there were about 1.5 million calls, which would call for 150 million shares.
So 150 million shares have to be purchased as well. Again, there was about 50 million shares, I believe he stated, that were outstanding. So this is a ton of shares. Now, this was specifically for GameStop, but I'm just saying that this all compounds. It's not just short positions, not naked short positions as well, but as well as contracts overall for the options chain. This all piles on top because they ultimately all have to cover at one point and buy the shares back. And because these are on margin accounts, they can't necessarily, for example, make the holders of the margin accounts, whatever the brokers that they're trading at, say, well, I need like another week. No, if the levels are passing the limits of their margin accounts, they can't have another week. At best, they'll have 24 hours. Sometimes you could request to have a 2-day, 3-day hold, but it depends if you're like a good customer and so on and so forth. Because I've seen times that they hold off for a little bit. But it depends, though. This is extremely volatile. For GameStop, though, for the BlackBerry, it would be a little bit different because if they see the volatility is controlled, then they'll give you probably 2 days.
When the shorts, if the longs repay their margin loans and exercise the calls, their brokers would have been obligated by the rules as they are today to deliver to them 270 million shares, while only 50 million shares existed. So when the shorts cannot deliver the shares, the broker representing the longs must, by the rules of the system, go into the market and buy the shares at any price, pushing the price into the thousands. So as the price goes higher, the shorts default on the brokers. The brokers now must cover themselves. They push the price further up. So the brokers default on the clearing houses, and you end up with a complete mess that is practically impossible to sort out. So that's what almost happened. To avoid this in the future, the SEC needs to immediately call for reporting of short interest on a daily basis because they are currently only reported twice a month. And I think they should increase margin requirements on shorts by 1% for every percent of short interest. That would solve the problem.
I will be posting more videos closer to the earnings date. They're coming up soon. And I'm going to compile a video like I did before a while ago in terms of the whole entire company, in terms of what they got going for them and so on and so forth. But yeah, thanks again for watching. I appreciate it. If you do want to be notified when I do upload these videos, sorry about that. I do post these videos on X and YouTube, so consider following so you'll be notified when I do upload them. Thanks again for watching. I'll see you guys next video. Peace.